Cryptocurrencies are digital assets that use cryptography to secure transactions and control their creation. They are decentralized, meaning they operate without a central authority or intermediary. Some of the most popular cryptocurrencies include Bitcoin, Ethereum, and Litecoin. A crypto hedge fund is a partnership that uses cryptocurrency to try and make large short-term profits. Crypto hedge funds work much like traditional hedge funds in that they allow individual investors to contribute to an expert-managed investment pot. The pooled user-contributed funds are then used to make investments in various blockchain projects, whether that be equity investments, early-stage tokens, OTC deals, or something else. Crypto hedge funds are attractive to investors who want to gain exposure to the fast-growing and volatile crypto market, without having to deal with the technical aspects of buying, storing, and trading cryptocurrencies. Crypto hedge funds also claim to offer high returns and low risks by using sophisticated strategies such as arbitrage, market making, algorithmic trading, and leverage. However, crypto hedge funds are not without their challenges and risks. Crypto hedge funds are subject to regulatory uncertainty, operational complexity, security breaches, fraud, and market manipulation. Crypto hedge funds also face intense competition from other players in the crypto space, such as exchanges, brokers, and platforms. In this video, we will explore how a crypto hedge fund crashed and burned. A story of trust and betrayal. We will look at how a crypto hedge fund promised high returns and low risks to its investors, but ended up losing millions of dollars due to mismanagement, negligence, and deception. We will examine how the crypto hedge fund operated, what went wrong, and what lessons can be learned from this case. We will also discuss the implications of this incident for the future of crypto hedge funds and the crypto industry as a whole. In this section, we will explore how the fund managers exploited loopholes and manipulated the market to enrich themselves at the expense of their investors and other traders. One of the main strategies that the fund managers used was to trade on unregulated offshore platforms that had lax or non-existent rules on market manipulation. These platforms allowed them to execute large orders that could move the prices of cryptocurrencies in their favor, without triggering any alarms or investigations. For example, they could use a technique called spoofing, which involves placing fake orders to create an illusion of high demand or supply, and then canceling them before they are executed. This way, they could trick other traders into buying or selling at inflated or deflated prices, and then profit from the price difference. Another strategy that the fund managers used was to leverage their influence and connections in the crypto industry to spread false or misleading information about certain cryptocurrencies or projects. They could use social media, blogs, podcasts, or even paid influencers to hype up or bash a coin, depending on whether they wanted to pump or dump it. They could also use their own media outlets or newsletters to create a narrative that suited their agenda. For example, they could claim that a coin had a major partnership, a breakthrough technology, or a looming regulatory threat, and then watch as the price reacted accordingly. A third strategy that the fund managers used was to exploit the interlinked nature of the crypto market, where the prices of different coins often move in sync with each other. They could use their large capital and trading volume to manipulate the prices of one or more coins, and then use that as a trigger to cause a domino effect on other coins. For example, they could artificially pump up the price of Bitcoin, which is the most dominant and influential coin in the market, and then use that as a signal to induce a buying frenzy among other coins. Alternatively, they could artificially crash the price of a coin that had a strong correlation with another coin, and then use that as a signal to induce a selling panic among other coins. By using these strategies, the fund managers were able to generate huge profits for themselves and their hedge fund, while exposing their investors and other traders to enormous risks and losses. They were able to take advantage of the lack of regulation, transparency, and accountability in the crypto market, and exploit the loopholes and vulnerabilities that existed. They were also able to evade detection and prosecution by operating in jurisdictions that had favorable laws or weak enforcement. They were essentially playing with fire, and eventually they got burned. The crypto hedge fund industry has been rocked by a series of scandals, lawsuits, and regulatory actions in the past few years. Here are some of the most notable cases that led to the collapse of some of the biggest and most promising crypto hedge funds. In December 2022, the SEC charged Samuel Bankman-Fried, the CEO and co-founder of FTX Trading Ltd. FTX, with defrauding investors in his crypto trading platform. The SEC alleged that Bankman-Fried diverted FTX customers' funds to his private crypto hedge fund, Alameda Research LLC, and gave Alameda special treatment on the FTX platform, such as a virtually unlimited line of credit and exemption from certain risk measures. The SEC also alleged that Bankman-Fried used FTX customers' funds to make undisclosed venture investments, real estate purchases, and political donations. In February 2023, the SEC charged Nishad Singh, the former co-lead engineer of FTX, for his role in the same scheme. The SEC alleged that Singh helped Bankman-Fried conceal the diversion of FTX customers' funds to Alameda and falsify FTX's financial statements and records. In February 2023, the SEC filed an emergency action against BK Coin Management LLC, a Miami-based investment advisor, and its principal, Kevin Kong, for running a crypto asset fraud scheme. The SEC alleged that BK Coin raised about $100 million from at least 55 investors to invest in crypto assets, but instead used some of the money to make Ponzi-like payments and for personal use. The SEC obtained an asset freeze, appointment of a receiver, and other emergency relief against BK Coin and Kong. In December 2020, the SEC sued Stephen Cheen, a 23-year-old Australian, for defrauding investors in his $92.4 million cryptocurrency arbitrage fund, Virgil Sigma Fund LP. The SEC alleged that Cheen lied to investors about the performance and assets of his fund, and tried to withdraw $1.7 million of investor funds to pay off Chinese loan sharks. The SEC also alleged that Cheen operated another fund, VQR Multi-Strategy Fund LP, which had no genuine trading or investment strategy. In July 2022, M.G. Stover & Company, the fund administrator of a Petersburg-based cryptocurrency hedge fund called Protos Cryptocurrency Asset Management LP, was named in a lawsuit by the fund's limited partners. The lawsuit alleged that M.G. Stover failed to detect and prevent a fraud scheme by Protos managers, who misappropriated $35 million of investor funds for personal use. The lawsuit also alleged that M.G. Stover falsified Protos' financial statements and reports. These are just some examples of how crypto hedge funds crashed and burned due to trust and betrayal issues. The crypto hedge fund industry is still young and largely unregulated, which exposes investors to high risks and potential losses. Investors should be careful and diligent when choosing a crypto hedge fund to invest in, and always do their own research before trusting anyone with their money.